What is the single biggest financial discipline that these companies have, and generally the startups generally don't have? I mean, they're lacking. You could elaborate on that.
Okay.
Yeah.
First of all, even making them understand that having focus on financial, statements or even a cash flow statement, making them understand this is important, right? I think that is the first step. Somebody who is in the bigger setup, they have already experienced this. They know by others around them mentoring them, they know that yes, finance is an important focus. But for a startup founder, when he is doing hundreds of things, when he is not having a big team to support him, his focus on finance tends to reduce.
Right.
I think it's more about the founder having that as a prime focus, that coaching, that mindset change. I think that is the most important thing I see as different from MNCs.
Hey, evening guys. This is Manav. So I'm a partner at Novation Strategy. We are helping out startups in terms of their mentoring and marketing and all kind of compliance support and funding out there in Delhi. Uh, in Bangalore, we are doing a podcast with somebody renowned in the financial sector. And while coming to Bangalore, I mean, it's always great to have the tech and non-tech startups. And this is where we want to come in and help out you guys. And for that, we thought of having a fruitful discussion. So the main focus for our podcast series will be, I mean, as a first in Bangalore, the main focus would be to have intelligent conversations. And we've selected people who can really do this for you and who can help you out with all your queries respect to equity, respect to dilution, being out of cash, your runway getting exhausted, worried about your burn rate, and so many other things. So we'll keep it simple and let's continue the conversation. And so, first thing that I'll say is that most startups don't die because their idea was bad. I mean, they die because nobody is watching the numbers. I mean, or worse, that they were watching it, somebody was watching it, but nobody really told them anything about it. I mean, they run on vision, the founders, and they scale on financial discipline, which is number one priority to be healthy and to keep running it, for which this first podcast starts today. Uh, and while they were not knowing all these things about maintaining that discipline, that consistency, and all those things, they became very late in this entire game. So I've got a guest today who'll be managing the FP&A for a company like Walmart, whose head closed a 50 million dollar Series B fundraise. She spent close to 20 years exactly learning where the companies break financially and how to build those systems. So, Manasa, she'll be helping you out to understand how you can uh, manage your financials. So she helps growth stage startups in terms of helping them keep up with their financial backbones, in line with what Fortune 500 companies does. Being a fractional CFO herself, and without the budget of a Fortune 500. A quick background about Manasa Hegde is that she's a chartered accountant with 20 years in corporate finance. She's worked at a number of corporates like Mindtree, Oracle, Juniper Networks, where she's handled financial analysis for them, uh, including Walmart Global Tech. And as I mentioned, she managed a $2 billion FP&A stuff with full focus on budgeting, forecasting, and cost optimization. Uh, I told you about the $50 million Series B fundraise that she's handled for the company. And now she's the head of CFO services at BakerTilly ASA, Bangalore. And she's working as a fractional CFO for people like you, the growth stage startups, and the GCCs in Bangalore. Me and Manasa sit exactly at the place or the intersection of growth strategy and structural integrity. Manasa, most welcome.
Thank you, Manav.
Yeah.
It's a pleasure being here with you.
Oh, great. And so, Manasa, you could tell me how's the Bangalore ecosystem been treating you, and what's your take on the startups and their wrongdoings and how they need to be doing it better?
Sure. First of all, thanks for having me here.
Yeah.
And I have been in this whole ecosystem, I think, for the past 7, 8 years. And definitely Bangalore is bustling with startups in different sectors. It used to be e-commerce, it used to be consumer friendly startups, something which is done out of love. Even now it is being done out of love, but more on the deep tech side. You will see a lot of startups in the aerospace sector, drone sector, and even the deep tech sector. I have seen the sector shift happening very slowly, and it's a very exciting space to be. And I know many of these startups have come, most of them are youngsters, and there are many who have come after an experience of 20, 30 years. But still, some of the challenges that I see they face could be solved with some discipline, some financial discipline and governance discipline. And if you catch this early on, it's an easy thing to manage.
Absolutely, absolutely. I mean, wonderful to understand that. Manasa, first thing that I'll ask for the audience is, and maybe we'll wrap it up with this again, is that you worked across Mindtree, Oracle, Juniper, and Walmart. It's nearly 20 years of, I mean, complex financial environment for sure. And these companies look very different in terms of their models and their workings. So, an outsider would say that the finances are going to be same P&L and everything. Minded, this must be very different for different set of companies. Something that Manasa can elaborate. So, I mean, someone who's run them from inside out across all of them. What is the single biggest financial discipline that these companies have, and generally the startups generally don't have? I mean, where they are lacking. If you could elaborate on that.
Okay.
Yeah.
First of all, even making them understand that having focus on financial statements or even a cash flow statement, making them understand this is important, right? I think that is the first step. Somebody who is in the bigger setup, they have already experienced this. And they know by others around them mentoring them, they know that yes, finance is an important focus. But for a startup founder, when he is doing hundreds of things, when he is not having a big team to support him, his focus on finance tends to reduce. I think it's more about the founder having that as a prime focus. That coaching, that mindset change. I think that is the most important thing I see as different from MNCs.
Right. And I think I would want to corroborate with something like this is the reason that the bank balance doesn't match the profits of people, or this is the reason that profitable companies go bankrupt.
Correct. I mean, what startup founders do is the top thing on their mind is a valuation or a top line growth, because those are funky numbers to quote when you're in a conversation with a VC or when you're in the market, right? But profit is very different from cash. It's not the same thing. You're, you will get a 1 crore contract maybe someday, but then is that what is sitting in your bank account? No. Most of the time, profit they exist in different universes. Profit is something bound by the accounting standards, accounting rules.
Absolutely.
Cash is real. Cash is what you see in your bank.
Absolutely.
So definitely somebody who has profit may not see that in his bank, and he may not be able to sustain his operation.
I mean, I do not like to really quote it, but there are so many companies who have their accountants doing this job rightly. I mean, to post those profits, do all that financial accounting, and bring out those numbers. I mean, so many of the big fours are already in this ensemble of being notoriously known for being part of it. I think the first one that came out of Bangalore was, or from Indian tech side, was the Satyam thing.
Correct.
Right. And do you want to say anything about the cash flow problems that the edtech majors like Byju's had to face?
Yeah, I mean, definitely. Byju, as you know, online education platform. So, Byju Ravindran, he started this whole thing sometime just during pre-COVID times. And as you all know, online learning boomed during COVID. So he instantly started doing rapid expansions, acquiring White Hat Junior, I think Akash Institutes from Bangalore. So rapid expansion happened. The growth wasn't kept at check. And with this, what happened was the spending on marketing, the spending on acquisitions increased, and I don't think his cash receipts could match his spend. So by 22, he had a $22 billion valuation. But then by 23, he was filing for 23, 24, I think. He was filing for insolvency and bankruptcy.
Absolutely.
So you just know that, there was a big mismatch. His growth expansions couldn't be funded by his bank balance.
Absolutely. I mean, that's somewhere these startups really need to be. So, what are the top three things that kind of come out of this? Byju's thing to your mind that people need to be taken care of. I mean, not top three, but let's say top two things.
Yeah,
In
definitely.
simple words.
Growth will not fund immediately. Growth will fund something later. But to fund that growth, you definitely need to have some cash in hand.
Right.
And not always, investors will look at just the growth or your expansion plan. They of course have their own scorecard where, me personally, when I work with startups, when I have to refer them to a VC firm, I have a scorecard.
Yeah.
What is the finance health of this company?
Yeah.
Cash flow, just out of their operations. That is the top metric which has the highest weightage. So definitely, even for a VC to put in more money, to pump in more money, you need to show that you are very sustainable from a cash perspective.
True that. I mean, I'll have a following question to that. I mean, good conversation in terms of cash flow and how the VC is judging you. Uh, so, what happens to the working capital when let's say it's the opposite case, and the company is doing good. So, what happens to the working capital when the revenue doubles? Or, I mean, what are the
When you go
warning signs suggest that a company is going faster than its
right,
cash can support? I think similar questions.
right. Say for example, you have just signed a 1 crore deal. Okay, you go on LinkedIn, humbled, gratitude.
Right.
You put all those. I just landed a 1 crore deal.
Right.
Now, when you actually signed the contract, what was the payment terms? Nobody looked at that. 120 days, because most of the early stage startups, you do not have sometimes you do not get the negotiation power to actually ask for earlier payment terms.
Right.
But so your collections is coming 4 months later, but your monthly payments to service this particular contract, your headcount, your rentals are due monthly, your vendors are due monthly, nobody waits. So 4 months, you're actually financing the customer. You have become like a credit line for the customer. So, I mean, I think that is where the gap is, right? Not just a top line growth.
Yeah.
Should also see how a particular contract can be negotiated better to ensure early collection.
Absolutely. Going to the other side, I mean, to the European and the American side, where you worked, Manasa, I'd like to understand the mindset of a Indian startup, or maybe somebody who's working on the Indian market. He may not necessarily be of Indian origin, or he may not necessarily be based out of India. So, like, you've worked across India and internationally. Juniper was EMEA focused. I think you were in Scotland or somewhere near Ireland at one point. So, how does the way Indian startups think about finance, and how does it differ from those people in European or the American financial culture? Number one. And is there anything specific about here in Indian startup mindset that creates those blind spots, and you have more failures coming sometimes than the successes, and VCs being more cribbing about their money getting lost in the drain? Or, I mean, I'll just add, or the VCs are not wise enough to see this. Where is exactly it's happening in terms of those culture, our Indian mindset, and whether VCs are at fault?
Okay. To be honest, on an Indian side, I mean, wherever, Europe or US, out of India, I think they know initially that, of course, it depends, right? There are cases where it hasn't worked, where there are cases where it has worked very well. But I think somewhere when a startup idea comes, the founders are more open to take advice from the network, from the professionals, and not just go with an attitude saying, I will take it when it comes, right? So they're more open to have a strategic kind of a CFO advisory sitting with them, and not just skimp on those governance and compliance aspects by just hiring a mere bookkeeper who will just record what you show them, but they will not question any strategy. They will not question what is going to happen in the future. So that is one thing I think, there's a slight difference from startups there. Compared to startups here, I mean, most of them, they do know that finance is important, governance is important, but it's only when you coach them, they realize I need to have it early on. By the time they realize I need to have a proper team, I need to have a CFO here, they are like 5-6 years in the making. Their books are already a mess, and that's when they're thinking of already doing a fundraise. So in a hurry to meet the investors' demands, in a hurry to pass the due diligence tests, they kind of scramble last minute to put all the 10 years worth of data in a proper format, ensure the due diligence is clean. I think that last minute scramble can be saved if you plan through on the financial and governance side of it as well. Once you have hit 2x kind of a growth, it's better to have it early on, catch them young and watch them grow, right? So it's better to have them early on.
Absolutely. I'll just take the conversation to another part, which is being a fractional CFO, Manasa herself, who's helping not one but multiple startups at same point of time across the globe. So like fractional CFO is one of the services that is everywhere right now, and because of the bootstrap budgets and so many other things, and people wanting to talk to one CFO but can't talk to him because of the location or other constraints. So like you are offering it, so many are offering it, and the startups need it. Everyone is trying to become a consultant here. Uh, I mean, what can a fractional CFO actually deliver for a, let's say, not a pre-seed or somebody, but a Series A startup in practice? And where does the model generally break down once you're offering this service? I mean, I'm asking specifically because this is more suited to you. And what can you do, not do as a fractional CFO than a full-time hire can? I mean, what are the benefits and how people can take benefit of this in case you guys are not aware of? So I'm asking this question. So fractional CFO is somebody who offers you those services at maybe a fraction of cost. And yeah,
part-time basis.
Yeah, if you could answer
Not
on
a
that.
full-time
Yeah.
hire. Okay. So yes, not every startup, until maybe they are funded well, can afford a CFO, a full-time CFO.
Yeah.
And that is where they take a step back, saying, I'm okay with just a mere bookkeeper who will just record what I say. But then when you have maybe a Series A done, a VC on board, they will expect more visibility in terms of how you're performing, what metrics you're tracking, and not just something about the past, something about the future. They need to align if the vision matches what you're reporting, the vision matches how you're going to perform based on the forecast. So to put the vision a lot together in a financial blueprint, that is where you need an experienced CFO with a strategic bent of mind, who knows what is happening in the market, who knows how VCs want to take a look at your firm's profitability and different metrics, business metrics. He can come at a fraction of the cost of a full-time CFO. He can give you the strategic advisory for the cost that is adjusted to your revenue levels, to your affordability, and at the same time, he is also covering you from a market performance perspective by giving you the right information at the right time. Say you're going for a customer pitching, so he could help you align on the pricing bit. He could help you align on the financial terms, but need to go into a contract. He could help you align on which is the best product fit, product market fit, so that you could have a business model that helps you become profitable at the end of the day. So all those strategic decisions. So a CFO makes your vision into the future be more financial metric oriented. It's not just something on the paper where you just talk, okay, this is my vision, but he actually brings that on paper. He shows you how your 5 years, next 5 years will look like. Will you make money out of it? Will you not? What do you need to do? So it will just guide you more on the next steps.
No, absolutely. So I'll have a pretty long question here on the legal and finance side at the cross junction of these two things. So Nasa, I mean, somewhere where I sit and somewhere you must be also dealing with. So you're helping out like startup clean up its finances for fundraise, right? And I want to know about the surprises, specifically the legal landmines that show up in this financial due diligence that the finance team did not flag for them, right? So we've seen like ESOP structures that create accidental tax liabilities for the people and firm. The revenue recognition clauses in SaaS contracts that misrepresent the annual recurring revenue ARR, or the intercompany loan agreements that took the equity away.
Correct.
Right. What are the financial looking problems that are actually legal problems in this guy? Yeah.
So I mean, yeah, of course.
Hope you've got hold of the
I've got it.
entire
So
context.
of course, I mean, definitely finance and legal is very interlinked.
Yeah.
So, I mean, just to quote an example, in the past, I have had experience where, not where I've worked, but somewhere outside, we suddenly got a penalty notice from a customer. And this was because some of the information we were working on with them got leaked out, and they could trace it back to somebody from our team. And that is when we started looking at how the incident happened, what we could do, and this was something in the ranges of dollars, thousands of dollars. So when we started digging, is there any contractual liability or some clause which will help us hide under from a customer contract perspective, where we don't actually have to shell out this penalty. But looks like the limited liability clauses, the confidentiality clauses there, which we most of the time tend to ignore, saying this is something which it's a legalese, right? We don't get much into what the legal words say. We have a standard template. We kind of replicate across all customer contracts.
I mean, you signed the term sheet agreement.
Yes, we just look at the financial, whatever needed, the scope of work, and the quote what we can give. We just sign off. Otherwise, it's a replicable template most of the time. Okay. So it was only after this fiasco that we realized the limited liability clause really needs to be something that we can afford as a startup. It cannot be something which goes to the tune of millions of dollars. Yes. There could be a mistake from our end. Maybe then it will go the arbitration route. Right. But otherwise, we need to have those limited liability clauses in place so that it protects us. So that was definitely something which was an eye opener at that time. Right. And similar to that, right? Small things which come as a part of maintaining financial hygiene, which is like customer master. Okay. Now I'll tell you how this relates to the legal things or compliance things. Right. Having a customer master which is clean, which has the customer name, the GST number, the TDS number, the PAN and TAN, we are able to trace starting from the billing all the way to the tax credits, withholding tax credits we are receiving, all the way to the GST. We are kind of compliance on the compliance side, the GST output tax that we pay. Right. So we should be able to track each of these things. Now, having a customer master is where this helps. A clean customer master with the legal entity name, the GST number plotted, the contract details, start date, end date, with the revenue recognition. Okay, if this is a SaaS annual subscription, but the recognition happens in different stages, and how would the customer kind of record this in his books? Have these details plotted, then you know when to take the tax credit, you know when to pay the GST output tax, and how do you match these timelines that your financial output is reduced to a certain extent. Right. So there are touch bases from a legal point of view, from a compliance point of view. So definitely these things come out. So having these in place in the initial stages of a startup will take you far when you're going for a fundraise or when you're in a 10x, 9x kind of growth. Right, absolutely. I mean, this is where you need automation tools that can put withholding tax and your GST taxes, everything in timeline, so that everything automation tools and data, garbage in, garbage out, right? If you're having all that data in a particular whatever tool, whichever tool you want to capture, and have the right data. Right. No, don't skimp on recording the GST number, don't skimp on recording the TAN, have the right legal entity name, just having 5 different names for a single customer. Right. Those are the things which that actually create the problem. Small things, but they throw you off. Have that data hygiene. Right. So maybe people can still keep using the simple bookkeeping tools. I would not name still keep using them, but they need to be at least aware of the nomenclatures that they're using in the names. Correct. What kind of data is needed? That's where the audit people are most smart enough to immediately crack. So like if you're keeping 5 names for the same vendor or same customer. Yes. So that is something you feel that you can avoid, but you cannot get off the eyes of the later you will just end up more money on consultants helping you reconcile this part. But so it's far better to keep yourself financially clean from day one than to get entangled into the disputes and tax notices. It also affects your cash flow. I mean, you might be paying out more without noticing that, okay, some credit was lying, I could have used that. So
people, I feel this is one of the takeaways of this conversation. That even if you are bootstrapped and are not able to afford a fractional CFO, certain things that you can do are coming out of these conversations, and you can start doing it. Probably you'll need them only for the main financial decisions and to bring your startup to the level where everything is trim and proper. But if you do things that are not even in the control of fractional CFO, then that creates a bigger, larger issue for even a fractional CFO to manage at a later stage.
Correct.
And for you to fight it off with the authorities.
Yes. Yeah. That's the stage they may have to hire a full-time CFO. So before that, get us in so that we help you get to that stage without any.
And sometimes subconsciously only, unconsciously only these things starts happening because you have not followed the rules of the game. Correct. And your innocence will not be a reason for you to.
Ignorance of law is not an excuse. Right?
Your innocence cannot be the ignorance of law. I mean, rules have to be rules. Either you become perfect in terms of your financial discipline, or the best is to have the right, even a fractional CFO on the board, or I mean, with your team. Yeah. So I would like to, Manasa, flip the table here, and because I think I learned as much as from the conversation as the listeners are doing. From your seat, what do legal advisors and strategy consultants, typically like us, get wrong about how startups actually make financial decisions? Where does the advice that these people give create friction instead of clarity? I mean, this is something on me, but if you want to answer that, where do the strategy consultants and the legal advisors get wrong and where they need to be right? And if there is any point that you want to mention, I mean, most welcome. But if you got positives to say, then
maybe we'll be really happy. Like you to go first. I mean, what comes in your mind, and then I would like to take you.
All right. So this is somewhere that we need to be very prudent in terms of telling the right structures. First of all, starting with the basic structure of a company, whether you've got it as a LLP or a proprietorship. In terms of compliances, you need to be aware of the jurisdictions and the whole gamut of things that are happening, especially when the person is signing an agreement with, let's say, an investor. So he needs to be aware of all the clauses before signing everything in a jiffy. So that tomorrow, so they can be, I would not say investors are such, but like you are dealing with an investor, he's also dealing with you. It may just happen that he's also forgotten to write something that could be of benefit to you, or something that he has written is detrimental, or something that's already a copy paste and that's already done and dusted, but something you need to put your eyes and ears open and read through the agreements as to when the equity becomes a debt, a CPP, and when you actually want to take a debt, even if you don't want to, and till what limit this equity dilution happens, so that what you say verbally is on the paper. So, and strategy wise, obviously there are a number of things that can happen, and we need to be careful of. So I think this is a place that startups also have the onus of responsibility to manage the affairs of their company, and I mean, not only in terms of financial discipline, but they need to be fully careful of dealing with X number of things that are there. I mean, that is the reason you are a founder and not a regular employee.
Correct. Yeah.
Thanks for flipping the table on the answer side also.
Thank you.
Yeah. Manasa, if you could give any 1, 2, or 3 non-negotiable financial things that must be in order for a founder before he walks into, let's say, Series A investor conversation.
Sure.
Not the nice to haves, but the absolute bare minimum.
Sure.
Even if one of these 3 is missing, what is the realistic consequences of this?
Got it. If you are someone who is already looking for a fundraise, and definitely understand your unit economics.
Right.
Are you making money off every customer?
Right.
Have that one point, understand what goes into getting the cash from every customer. What is the cost you're spending on?
Right.
The second is definitely understand where is your business headed. Have a cash flow forecast. Have it for the next 4 or 5 months. Ensure you have a runway. Depends upon the business, but something up to 6 months is good. 12 months is ideal, but anything less than 6 months is a warning sign. So have a cash flow forecast and understand how cash moves in your business, right? Maybe you have customers, one customer who is owing you 40% of your overall revenue. So it might be customer concentration. So ensure that doesn't cause a dependency. So understand how the cash moves in your business, and definitely cash is king. So
absolutely. So out of these three things that you've just listed, would you say that the answer comes to this question also, which is about, I mean, without naming anyone, what is the most painful and preventable financial mistake you watched a genuinely promising startup make? I mean, the one that sits with you and it did not have to happen, but it happened within or the startup.
Let your operations make cash for you. Don't just depend on a fundraise to bring in that capital. Fundraise is a strategic capital. It should be for expansion. It should be for bringing in a new market, or maybe you're hiring CXOs. But never should cash flow be funds be gotten to fund your regular operations. Let your
regular working capital.
Yes, let your operations bring in the cash for you. Let have that cycle going on.
Right. So founders and friends, I'll just wrap this financial expert session with the support and help of Manasa Hegde, our close friend in the space out here in Bangalore. That I'll give the honors of closing this session to Manasa as to what are the things that she has on the top of her mind for advising you founders out there. Manasa, over to you.
Thank you, Manav. So definitely the last thing is, see, profit is vanity. That is something to show off to the outer world, but cash is sanity. So ensure that you have cash as your top focus, and that will take you a long way. Cash gives you the option to leverage with investors, with VC firms. So I think the focus should be more on how your cash is moving. And thanks to Manav for having me here. And I think Manav and Divyansh, they're doing a great job on the coaching the founders, helping them get the legal and finance together, financial advisory together. So good luck to you, and hope to see you again in the future.
Same here. And thanks, Manasa, for bringing this fresh new topic to the audiences. I have not seen much of such topics coming up, not on the financial side itself, but being bootstrapped and still having that financial discipline with stalwarts and experts. And I'll just add that you're getting the Fortune 500 budgeting, but not at that budget, but at a fraction of cost. Take care.
Thank you.
Bye. Thank you. Thank you.